Hey guys, welcome and welcome back to my channel once again. This is Abhishek, your friend but not a financial advisor. And with that being said, guys, please consider this video as only a part of your own due diligence. I'm not a financial advisor. I'm not telling you to buy this stock or just follow the numbers as it is. They are, because they are just my assumptions. So when you see the numbers in the evaluation model, don't take these numbers as it is. Those are my assumptions, and all the valuation is based on the assumptions which I have taken into consideration, looking into the historical model and looking into the history of this business. And that's why, like always guys, don't follow any advices here on YouTube. None of us are financial advisors until and unless someone says that they are literally certified financial advisor. But okay, anyways, with that being said, now let's just jump on to the video, because this video is going to be long, and I hope that you do smash the like button and watch until the end, because this is an amazing video, to be honest guys, and you will find everything what you require to know about this business in one single place. But again, you would have to do your own research, of course, because that's how you should be doing stuff. So let's get going. Okay guys, so the company which we are going to talk about today is HelloFresh, which is actually a German based company, and therefore you can find them on the German stock exchange like Xetra, GetX, TradeGate, or Munich, Frankfurt, Berlin, Stuttgart, and so on and so on. So the current price at which the stock is trading while recording this video is sitting at 72 euros, which was up by 4.48% from the previous trading day. So before we move further in this video, you will see some comparison of this company with Tattooed Chef. Why I'm comparing this with Tattooed Chef? First reason, so overall they are basically same type of a company. Yeah, if you dig deeper into their business model, then it's quite different, because Tattooed Chef is more focused on frozen food and meat replacement food, while HelloFresh is more focused on cook box or subscription plan model. They are giving you the recipe, they are giving you the ingredients to make your cooking much more easier. You have to cook yourself, but on the other hand, Tattooed Chef is already giving you ready to eat. Yeah, you just have to warm it up and that's it. And the second question you must be asking me, that why the hell I'm comparing a company, Tattooed Chef, which is sitting at $17 with HelloFresh, which is sitting at 72 euros, almost $88 US dollars. That's the reason why actually I want to compare HelloFresh with Tattooed Chef, because there is a huge misconception amongst many young retail investors that if the stock price is expensive, then the company is expensive. No guys, this is what I will show you in this video, that please don't look into the stock price, look into the business, look into the numbers behind, look into the numbers in the financials of the company, look into the growth of the company. So this is what I would like to explain to you guys, and that's why I will be taking Tattooed Chef as comparison with HelloFresh. So now let's move on further in this video. So first, let's have a look at what they actually do. So they are actually literally changing how the people eat forever, and their vision is to become the world's leading fully integrated food solutions group. Okay, so this is basically how HelloFresh works. So all you have to do is choose a dish and order that dish via HelloFresh app. And then the next step would be that HelloFresh will collect all the vegetables and the meat according to the dish, of course, and will pack it in a box, environment friendly box. Okay, and this is what they call the cooking box. So everything will be packed in a box and will be delivered at your doorstep. So this is the main advantage. And after that, of course, you just open the box and start cooking by following the step-by-step instructions, which is of course included in the box. And yeah, there's your meal. So when I said that I'm comparing HelloFresh with Tattooed Chef, they are not doing the same thing, of course, because Tattooed Chef is basically replacing the meat, yeah, and more concentrated on the frozen food, focusing on the frozen food, ready-made food. And here we have also easy to cook concept, but we are including here vegetables and meat both. Yeah, so this is basically a much more let's say easy to get stuff and cook. But on the other hand, Tattooed Chef is more focused on easy to cook and also meat replacement recipes. So both are quite different, but the industry is the same, and that's why I'm taking HelloFresh as a comparison with Tattooed Chef. So if I just click on the recipe and the current menu, and you can see that these are some of the menus which are available from 22nd May till 28th of May, and you can see that they have vegetarian and they have everything with meat as well, and you can also see the cooking time 35 minutes. So let's click on this hamburger, and you can see, okay, this is okay now in German. So these are some of the ingredients which they will deliver in the exact amount which you need for making this meal, and you can select how many people are gonna have it. So 1, 2, 3 for the full family. Then according to that they will adjust the ingredients, the amount of ingredients, and you can see the cooking time is 35 minutes, and that's all. So that's how it actually goes. So you can see express lunch, yeah, with some beetroot sticks, and these are the ingredients. So everything is there, everything is fresh. You don't need to literally buy anything from the groceries. So salt, pepper, everything, literally everything. So not just the meat or the veggies, but literally everything what is required, all the spices, salt, pepper, oil, even oil. So that's like from the scratch. All you need is your own dining table and the dishes, of course. Okay guys, so let me make this quite clear once again quickly, because I might get a lot of comments after this video that why the hell you are comparing Tattooed Chef with this company when the business model is completely different. Well guys, both are online retail business, okay? So in overall picture, both are in the same category, same industry. So please watch the complete video, because in the end you will see the overall evaluation of just this business without the comparison with any other business out there. I'm comparing this business with Tattooed Chef because I could only find one public company which is quite famous, to show you guys that price of the stock doesn't matter. Please, this is the sole motive of comparing this business with Tattooed Chef. And trust me, just in itself this business is a wonderful business, and you will see this in the end of the video. So please watch the complete video, and then of course I can't stop the comments. If you want to still comment and put these comments, then feel free to do that, but I would appreciate that you watch the complete video and get the idea of this business. So why HelloFresh? Well, this is what I found. So a HelloFresh meal could cost around $7.49 per person. Of course that depends on what meal and what type of vegetables and meat you have ordered, and if you have compared it to your grocery store shopping, then it would have cost you around $9.74. Again guys, this is just an example that, and in many cases, 90% of the cases, HelloFresh is coming out to be much more cheaper. And in restaurants, of course, it will cost you around $34.60. I mean, that's the most expensive part, and we should not be even comparing this price, but anyway, still. So in total we are actually able to save $53 to $346 a month, and this $346 of course is also including the restaurant prices. And this is the second reason. Well, the whole video actually is about why HelloFresh, but these are the two basic fundamental reasons. Okay, so this is just to simplify the business model. So as you can see, the traditional supply chain might take up to 10 days to reach our home, and we have 23% of food waste. But in case of HelloFresh supply chain, producer, HelloFresh, and finally the customer. So that means more margin for profit, which is quite understandable because we are removing many middlemen, and therefore we are saving a lot of profit margin, and that's how the business is growing, and no food waste, and this is more environmental friendly. Okay guys, so now since we got that covered and that's out of the way, let's just jump onto a much deeper analysis and some bullish analysis about this company. So their plan is to actually grow their revenue up to $10 billion with a compound annual growth rate of over 15%, and all this is possible by their strategies of expanding their business into already existing markets, so penetrating into already existing markets, and also by growing their business in different countries, so opening up into different geographies and launching their products in international markets. And since that we can say that they are in the e-commerce sector, we can see that actually because of being in this sector, their revenue growth has been quite stable and also has been growing consistently. And also, as you can see, by the way, this is just for US only, we can see that HelloFresh has been performing quite amazingly well as compared to their peers, and we can also see that right here. So their revenue growth has been phenomenal, so you can see that the revenue growth is quite exponential, and earnings as well. So okay, like I said, the business was growing before and the earnings were not that great, but now they are in positive earnings, and that's a really huge growth, guys. 369 million earnings from minus 10.2 million of earnings. Okay, now if you go on to the quarterly chart, we can say that okay, pre-pandemic levels, e-commerce businesses were doing quite good, but you can see that in the Q1 2021, the revenue grew by over 29%, and This is what I call a business which is now not dependent on any lockdown or stuff like that. They actually manage to penetrate into the life cycle of the people who are actually falling in love with this type of food delivery. Okay guys, so as you can see also that compared to the market opportunity they have in this industry, which is up to $3.3 trillion, they have just a revenue growth of $4.3 billion. Now, I usually don't consider market opportunities like I see that people are talking about market opportunities in EV sector and whenever they are talking about a new stock, but I usually don't do that because the bigger the market opportunity becomes, the more competition we have. And that's why for me it is important, but that is not the sole factor which I will fully concentrate on. But why I'm looking into the market opportunity in case of HelloFresh? Because literally there is no big competitor out there who is first of all trading publicly as HelloFresh in this market segment. So that's why I am interested into the market opportunity for HelloFresh. And we can see that we do have a huge growth opportunity in case of HelloFresh. So now just imagine guys, they did quite well until 2020. They became from non-profitable business to a profitable business and their margins improved like hell. And this was only when the e-commerce market adoption for the food and beverage industry was just increased by 2.4%. And now just imagine how much potential they have still when the industry is supposed to increase by almost double, so 4.4%. And that's why I am believing in this company. And of course, the company can grow if the product improves. And this is what they are doing with their product. So as you can see, from 2017 until 2020, they actually managed to penetrate into the market according to the new style, like quick and easy, calorie smart. People became more health conscious, and that's how they're actually adapting to the market. And this is what I like about this company, and that's what they will do until 2025 and beyond that. And of course, their total addressable market is expanding at an alarming rate across the globe. And guys, this is what I like about a business, especially such businesses, because they, in the earlier stages, they took few years to set up their business. They didn't bother about the profits and didn't care about such things. And this is why I give a business 2 to 3 years to actually establish. Okay, it depends upon different businesses. It can take 5 to 10 years. Like I like Palantir, to be honest. And I think that people say out there they have been there for 2 decades and they are still not profitable. I mean, guys, that's a software company. You don't have to be profitable. Everything which goes into a company is into R&D, and that's why they are not profitable yet, but because they're working on their software. But anyways, that's a different story. So that's what I like about them, because they took their time to establish the infrastructure and tools, which is really important for an e-commerce business, because they have to have logistics, procurement, production, and all that setup, all that infrastructure, which can make them a profitable business one day. And here they are profitable now. And this is what I like about them. And this is what I'm talking about, guys. Look at this growth rate. Look at this. Isn't that amazing? And this is what this business is about. I would anyways further in this video dig deeper into the financials of this company, but this is just to show you guys that how strong and fundamentally sound this business is and how strongly this business is growing on an year-over-year basis. So these are the Q1 highlights. So as you can see, very strong year-on-year and sequential growth in customers across both segments to 7.3 million. Continued high order rates, constant currency revenue growth of 116% to 1.44 billion euros. And then they had an adjusted EBITDA of 159 million euros with a margin of 11%. And guys, this is really amazing. Then they further have the capacity to expand, fully on track with ramp up of 2 new fulfillment centers in the US and 2 international in Q1. So this we will see in the Q2 how they progressed with this. And recently they also had an acquisition of ready to eat in the US, which actually contributed to the company's success. And we will see in the further quarters that this factor will actually play quite an important role. And as we can see that their average order rate actually compared to Q1 2020 increased by 14% in Q1 2021. And like you can see here, they had a double-digit adjusted EBITDA margin in both the segments. The 2 segments which you're talking about here is USA and international segment. So we can see even in the case of USA in Q1, there was 11.5% adjusted EBITDA margin, and international 13.3%, which was a growth of 3.3%. Anyways, guys, I have a lot of information about this company. I will anyways leave the links to these presentations down in the description below. You can have a look at them. I just covered the few important points from my point of view, which are quite important to let my viewers know about a business, and the rest you can do your own research. Anyways, you should be doing your own research, and this video will become very long if I go through each and every single point which I want to cover, but I don't want to do that, so that's why I leave that up to you. I'm covering the needful information which is sufficient for you guys to know about the business, and then you can of course do your own research and then make a decision. So now let's just jump on to the comparison between HelloFresh and Tattooed Chef, and later on let's do the evaluation part. So okay guys, now let's come on to the interesting part of this video, which is the financial comparison between HelloFresh and Tattooed Chefs. So I have just jotted down some of the key important numbers which are quite important in order not to make this video quite lengthy. So at the time of making this video, the market cap of HelloFresh is sitting at $12.38 billion, while for Tattooed Chef is at $1.55 billion. So now let's come on to the income statement, and from the income statement we have the current revenue for HelloFresh, by the way, for the trailing 12-month period. This is for the trailing 12-month period, all these figures. So we have revenue of $4.493 billion approximately, and for Tattooed Chef $149 million approximately. So now the cost of revenue is, or the cost of sales is sitting at $1.5 billion for HelloFresh, while for Tattooed Chef is at $124 million. Now do you guys see already the difference between how much money HelloFresh is able to save from its sales and how much money is Tattooed Chef able to save from its sales? It's incredible. The difference is incredible, and we will see this in the gross margin. So the gross profit HelloFresh is making is $2.9 billion, while Tattooed Chef is making $23 million, and that gives us a gross margin of 66% for HelloFresh for the trailing 12-month period, while for Tattooed Chef just 16%. So this is incredible. Now of course there are many arguments out there, oh, Tattooed Chef is a growing business and this and that. Yes, I understand that, guys, and that's the main aim of this video, to show you guys that we do have another value investment compared to Tattooed Chef. Even though the stock price is 5 times much higher than Tattooed Chef, that doesn't make a business expensive. That's just the stock price. But anyways, moving on, we have an operating income or operating loss from the income statement, and HelloFresh has an operating income of $524 million, while Tattooed Chef is still making an operating loss of $8 million, which is okay. This I understand that they can take some time to get into an operating income, because actually HelloFresh as well was not long before generating operating loss. So as you can see right here, actually HelloFresh was generating an operating loss of $19 million and until 2019, and they were quite bad before. But do you see this improvement? This improvement is amazing, and this is what I'm talking about. It doesn't matter if the business is making an operating loss, it's okay, but they should be definitely working on their margins, and you can see that from their financial improvement from the year 2020, how they improved their margins. And this is what I'm talking about. I don't care if the business is making a loss, it's okay. If the business is brand new, I expect that, okay? I don't expect a business to become profitable in just 1 to 2 years of time, yeah? But we have to see that how is the outlook of the business in the future? Is the business going to become profitable? Are they working on their margins? How they're generating cash? And this is most important. So anyways, moving on, then that gives us an operating margin of 11.6% for HelloFresh, which is okay, not that high to be honest, but I would give them a benefit of doubt how they actually improved from becoming the company in operating loss to operating income, and which is amazing. So for Tattooed Chef, we have an operating margin of minus 5.9%, of course, because we have an operating loss here. So okay, never mind, moving on. Then of course we have a net income, which is for HelloFresh is sitting at $430 million, while for Tattooed Chef is at $67 million. Now coming on to the balance sheet to see how stable is the business, how well established its assets versus its liabilities are. This piece of information is also very important from the financial point of view, because this actually tells us that if the business is going to or is near bankruptcy or not. So anyway, so current assets are sitting at $922 million for HelloFresh, for Tattooed Chef 206, and current liabilities are sitting at 519 for HelloFresh, while for Tattooed Chef just $30 million, which gives us a current ratio of 1.77. Any current ratio above 1 is incredible, but above 2 is much more better. And for Tattooed Chef, we have 6.8. Okay, and that means that they do have some assets to liquidify to fuel up their operating expenses, which is, as we see, are quite high. So that makes sense. That's okay. That means they are, say, fundamentally stable. And then we have the total assets for HelloFresh sitting at $1.5 billion, while for Tattooed Chef $266 million, and total liabilities are sitting at $869 million, while for Tattooed Chef just at $32 million. Now, seeing this, I do see that, okay, Tattooed Chef is at a better position in terms of balance sheet, but the most important thing here is the tangible book value. So why for me tangible book value is more important is because usually the book value or the assets, these assets can contain many phony assets, which Warren Buffett says phony assets, because these assets can be goodwill, which actually cannot be liquidified. These assets cannot be liquidified. These are simply the assets which are, let's say, as the name says, they are based on goodwill. So for example, if I as a buyer wants to buy Apple, then let's say Apple is selling at a market cap of $15 billion and I'm ready to pay $15.5 billion because the company is amazing, the growth potential, it has huge growth potential, and I just want to give $500 million extra just to buy the business because I might get ahead of someone else to buy the business. So this is goodwill. Yeah, this cannot, you cannot liquidify. This term is not constant. So this you cannot actually bake into the actual buying price. Anyways, so these are the assets which I personally don't consider when I'm calculating the book value. So that's why for me the tangible book value is much more important. And as you can see, that tangible book value for HelloFresh is much more higher than Tattooed Chef. Now Tattooed Chef is not bad either. And guys, please understand that I'm not against Tattooed Chef. I myself am invested in Tattooed Chef as well. But here my main aim or main purpose is to give you guys some valuable information in order to choose some other alternatives which I think is could be much better. I personally also missed on HelloFresh, but now I'm thinking to consider investing in HelloFresh as well. Though I will have two stocks from the same sector, but yeah, why not? I mean, it's okay. Anyway, so moving on. So for the cash flow statement, we have operating cash flow. So HelloFresh is generating positive cash flow from its operations, which is quite good to see, while Tattooed Chef is generating no cash, positive cash. It's in minus from their regular operations, which is the most alarming situation according to me as an investor. But again, like I said, this is a comparatively new business, so let's give this business some time. Then we have cash flow from investing activities, which are at minus 218. That means they might have bought some assets and that's why they are negative. And same goes for Tattooed Chef at minus $7 million. And then from financing activities, we have just $119 million for HelloFresh, while for Tattooed Chef, the majority of their cash is coming from financing activities. Now, this is a red flag for me because you can see that the operating cash flow for HelloFresh, the majority of the cash flow which they are getting, like you can see, end cash position is 878, and the majority of the cash flow is coming from their operations, which is the best thing you can see in a business, that they are generating cash from their basic operations, from their sales. But if you see that a company is generating cash from its financing activities, that means they might be doing more dilution, they might be taking more debt, which is not that great for a business, right? So we can see that for Tattooed Chef, it's coming from financing activities, and that's why it's quite a red flag. Now you might be asking me that why the hell I invested in Tattooed Chef, because guys, I liked the business in the beginning. Yeah, I actually invested in it when it actually went public. So at that time, I didn't have all this data. I just had few numbers in my mind and I thought that the business will be great. I still think that this is a growing business and they have the possibility and they have the opportunity to grow. So that's why, and my price is $15 for Tattooed Chef, so I don't really care. So anyways, moving on, then we have the end cash position of $878 million for HelloFresh, and for Tattooed Chef $131 million, which we already covered. So we have a free cash flow for HelloFresh, which is $580 million, which is quite good, because a business in the end should be generating a positive cash flow. This is what you want in a business, because this is the whole purpose of owning a business. If you own an apartment, you want that from the rent, you save some money. That's the whole meaning of acquiring a business or having some asset or having some investment, right? So in case of HelloFresh, we have positive cash flow of $580 million, while for Tattooed Chef, we still don't have any positive free cash flow. Now getting on to some key ratios to get some basic evaluations. So we see that the price to sales ratio for HelloFresh is at 2.7, which is amazing. In this sector, let's say 2.7 is really amazing. And then for Tattooed Chef, we have 10.4. So it's really 5 times expensive. So now the price to free cash flow we have for HelloFresh 21, which is according to me expensive. I would consider a price to cash flow ratio of 15 to 20, somewhere between 15 to 20. But if I compare this to Tattooed Chef, it's basically super cheap. So for Tattooed Chef, we have basically minus 75,000. So they have to work on their cash flow, of course, but we have to give the business some time. And now we are talking about getting into a business at this particular moment. So price to earnings ratio, they both are at the same level. HelloFresh is a bit expensive, but I don't mind paying for a business at 28 price to earnings ratio for a growing business. Considering all these facts which I see here, I think price to earnings ratio for HelloFresh is of 28 is not that expensive, to be honest. So from the financial point of view, that's it, guys. And I hope you got a really good idea from both the businesses, and it will make easier for you guys to make a decision. But anyways, now let's move on to calculate some basic intrinsic values. Okay guys, so finally we are here on the valuation of HelloFresh, which I think many of you guys out there might be waiting for this part to come. Well, here it is. So anyways, and before we dig deeper into the valuation model, I would like to clarify one thing, that this is not a detailed discounted cash flow model, though this is a really good model also because we are here discounting the earnings per share instead of the cash flow, because I don't want to make this video too long in explaining the discounted cash flow and putting all the values. So this is a similar type of model, and it also will give us a really good approximation. Of course, every approximation is based on our estimation, yeah, and speculation. So doesn't matter if it is a discounted cash flow model or if it is this model, it doesn't matter, because ultimately everything depends upon what you are estimating, what you are expecting out from your investment, out from the business. So anyways, we have here earnings per share. So like I said, I'm not taking the cash flow here, I'm taking the earnings per share, and then we will be expanding this earnings per share for the next 10 years depending upon these estimates right here. So now the earnings per share for HelloFresh is 2.13. Now how I got this value? So earnings per share basically is earnings minus the dividends divided by the number of outstanding shares. So for now, HelloFresh is not giving out any dividend, so it's simply the ratio between earnings and the number of shares outstanding. So earnings we have already here 369 million euros, and then we simply go on to the statistics here and we check out the number of outstanding shares, which is 173 million, and that gives us the ratio of 2.13 earnings per share. Okay, so here we put 2.13, and now why I took the growth rate 20%, and 20% is coming from the earnings forecast from the analysts out there. So as you can see that the analyst forecast for 2022 is supposed to be at 411 million euros, and currently it was at 341 like we already saw, which is an upside potential of 20% approximately. And then for 2023 they are projecting an earnings of 504 million euros, which is again an upside of over 20% approximately. So that's why I'm taking a growth rate of 20% for the earnings year over year. And guys, I'm really being conservative. Even if you see that the growth rate, expected growth rate, and the average growth rate for the revenue and the earnings is amazing, above 30%, above 50%. And here we can see some more details. So we can see that the revenue estimates are amazing, $7.35 billion in 2022 and 6.38 $8 billion in 2021. In the end of 2021, the revenue growth was 115% year over year, compound annual growth rate of 65%. The earnings per share year over year is actually 419%, and the levered free cash flow year over year is 543%. You can see, guys, that this business is growing at a phenomenal rate, but of course the growth will slow down eventually. This is common for many businesses which are growing in the beginning at a really fast alarming rate, and eventually they will slow down, of course. And you can see right here that the earnings per share is actually 2.96 for the trailing 12-month period, because of course if we consider that they are paying an annual dividend of 30 cents and the yield is 33%, so we can say that okay, 2.96, but I will take just the earnings and divide it by number of shares outstanding. Now of course the important thing is here the number of shares outstanding, because this eventually is diluting the shareholders and the investors, and this is the factor which we always have to consider. So now I'm just taking the number of outstanding shares currently in this period of time. So now getting back onto our Excel file and to show you guys that how this conservative approach for this company is also giving us a really good value. But before that, guys, I would like to show you one thing, that as you can see that they recently smashed the revenue expectations, and this is what I'm talking about, that yes, 20% growth is projected, estimated projection of this company, but I'm pretty sure that they will be growing at a much faster rate, and that's why we have two more scenarios here. So we will take two more scenarios into consideration, and then we will get a final value which I think is much more let's say closer to the fair value. So anyways, so moving on, so I will take here the next 5 years a growth rate of 20%, then 5 to 10 years I suppose the growth will slow down, and then the discount rate. So discount rate is quite important here. I'm not using the weighted discount rate, yeah, I'm using the discount rate as an expectation of return on my investment, what I expect from this company, which is 10% for sure. And this actually also depends on you as your own expectation, your own speculation, what you actually want. So the higher the discount rate, the lesser the value will become, because of course if you want much more high returns, you have to buy a business at a cheap value, right? That's how it's done. So now moving on to the terminal value. So the terminal value here I'm taking is price to earnings ratio, because we are talking about earnings per share and not the cash flow. So that's why the terminal value is supposed to be earnings, yeah, and therefore I am taking 30, which is actually the current price to earnings ratio of this business. So if I put these values, we get an intrinsic value of 120 euros, which is still 62% above the current price of this company. So this is according to the fair valuation. This should be the fair value of the stock. Anyway, so moving on to now the best case scenario, the earnings per share remains the same, 2.13, and here if I take 20%, no sorry 30%, this is the best case scenario, sorry. So if I take 30% growth rate, which I think can be possible and is achievable because they did it in the past, more than 30% to be honest, and then the growth rate will drop down, let's say to half, because here we also took the half. So the growth rate drops down to half of the growth rate from the previous 5 years, and the discount rate remains the same because this is what I expect my return on my investment to be, and the terminal value will keep the same because I don't want to pay more than this value even in the best case scenario, to be honest, because the average price to earnings ratio for the German online retail industry average is also around 30. So let's keep that to be at 30. And then we have the present value of 206 euros. And now if we take the worst case scenario, keeping the earnings per share the same, then we take, let's say, the growth rate to be at 5%, but the growth rate to drop down to 5% in the next 5 years, which is I don't think is possible in any way. But anyways, we are talking about the worst case scenario. And then if we take that, okay, the 5% stays, because in this case we are literally dropping down the growth rate by 4 times, and that's why we keep the same growth rate for at least the next 5 to 10 years. And then the discount rate is the same, and of course then the terminal multiple is just more cheaper, and this gives us a present value of 42 euros. And now if we take the probability, so this is the important part, guys. So we take the probability that 50% is the probability that growth rate and this aspect of the valuation will be happening in the future as well. In the best case, I would take 20%, and the worst case, I take 30%. So this gives us a value of 113 euros, which is still an upside potential of 52%. So guys, this is the general idea of the business valuation. Everything depends upon your estimations, your speculation, and what you actually want in return from the business. But this is to give you guys an idea that, in my opinion, and according to my calculations, I still see an upside potential of 52% for such a stable value investment. Okay guys, so this is how the evaluation for HelloFresh looks like. Of course, this is according to my personal opinion, my assumptions, my calculations. This video is going to be too long, so I will not stress this further. I will just conclude this video by saying that this is a really wonderful, fundamentally sound business. So I would consider this as a value investment for me, considering the current price, the current market cap, and the current growth rate. And I do see that this business has a future potential. Of course, the growth rate might not be as crazy as it is right now in this current moment, 400% earnings per share growth and 100% year over year. I mean, of course, it might be possible, but I don't think that this will keep on going. The business growth rate will slow down eventually, but still, I do see a huge potential in this business, and we have considered, let's say, relatively conservative approach, like you already saw from the real statistics, that the growth rate is phenomenal, over 100%. But this is how I evaluate this business. I am more of a conservative person, so that's why I have taken some conservative numbers right here. But yes, that's it. That's all from my side, guys. I will end this video finally, and with that being said, I will see you in the next one. Cheers till then.